What is the difference between term, whole, and universal life? Welcome, this is episode 1 to our Secrets to Tax-Free Growth series. Today we are starting from the very core, the foundational information that you need to be able to take your financial future to the next level. Listen, if you just take a few hours and go through this entire series, take some time to educate yourself. If you're someone who's just starting to save for retirement, maybe you just got a job and you can only put away $1,000, $2,000 a month, your future self will thank you. If you're just getting ready to retire, but you're tired of market volatility, worry about future tax rates, you just want peace, you just take the time to educate yourself, you'll be happy you did. Or if you have more money than you could ever imagine, but you just want to optimize your dollar, you wonder, how can I transfer this to my heirs optimally? You finally get to learn what the rich have been doing for over 100 years. Your time and attention is very valuable. I'm honored to have it, and I do not and will not take it lightly. Let's get started. If you're like me and you're a very detail-oriented engineering type that wants all of the information, or if you're just someone who wants to learn by stories, charts, examples, metaphors, this series is for both of you. I've decided to do exactly that. In order to best do that, I think it is important to start from the center, from the ground level, and build our way up. That is why today we answer the simple question, but very important question, of what is insurance and what are the differences between the different types of insurance. First is, what is insurance? What we're doing is we're making a non-profitable wager in the eyes of the insurance company in terms of just money, because we view the impact of the negative would far outweigh not taking the non-profitable wager. A more simplified example, we pay a certain amount of something to guarantee if disaster were to happen, that other things would be taken care of and be okay. Life insurance, for example, we pay a premium. If we die, our beneficiary will get a death benefit. The insurance company is a business, of course, so they believe that we will pay enough premiums that will either be more than that, or will pay enough premiums that they can take and invest somewhere that will grow to be more than the death benefit based on the likelihood of you actually dying. So I have this little chart here. We have it starting at 30 years, going on in age in the x-axis, and in the y-axis, this is COI, otherwise the cost of insurance. First, starting with just your annual renewable term, what happens is there's mortality tables. The older you get, whether you're a male or female, regardless, the more likely you were to die. So people would pay for insurance. They'd say they'd be 30 years old and say, dang, if I passed away, my wife, she doesn't work right now, or she does, but my income would be gone and she wouldn't have enough money to raise the kids, etc. There's many other reasons. That would be a disaster. I want to make sure if that does happen, that she would be okay. So what they do is they buy insurance. Well, since the cost of insurance got so expensive as people got older, eventually whole life was introduced. And what that is people said, what if I drew this line here? What if I paid this much forever? So I'm gonna way overpay in these early years, right? I'm paying all this time, even though the cost of insurance is only this much. And since I overpaid all those years, I can just continue paying that same amount forever. And the interest that all of this gained is actually going to cover all this. So hey, can I just pay more earlier? That way I'm not having to pay way more down the road. Now that's normal whole life. Then people said, well, what if I just, usually people retire around, let's just say age 65. What if I just paid this much, even more, until age 65? Pay all of this whole time. You're paying way more than the cost of insurance, but since you paid even more, you can just stop paying here because all of this additional money is actually going to be able to cover this. People took it a step farther. What if I did it in 20 years until age 50? Then you have all of this covered. You only pay for 20 years, you pay much more, but there's enough cash value in there to where once you're done paying, you never have to pay again, you're insured, you're good. People even did it for 10 years. So you can see here, if it went to age 40, you'd have that, only paid it for 10 years, and now you have insurance for the rest of your life. Even up to a single premium. I put in one payment, and I'm done for the rest of my life. Well, in 1980, universal life came out. And what people realize is, so in this example where they fund the policy for 10 years and they're done. Okay, in this whole life policy, what I'm able to do is fund it for 10 years and then it covers the rest of my life. The reason that's able to happen is because I fund it, and then what's it doing? That money's growing over time. So the insurance company in some form is giving you cash value and they're letting that grow. Well, they're letting that grow tax-free because you're not paying any taxes on it, right? You pay it for 10 years and you're done. So of course it's growing tax-free. But when you die, what happens to the death benefit? Well, it's insurance, right? It's a life insurance contract. So it transfers tax-free. Well, they also have these loan provisions. You can access the money tax-free and you can withdraw everything you put in tax-free. So the E.F. Hutton brokerage firm realizes this and says, hold on, we're putting in this money just for 10 years and stopping so we have the insurance paid off. What if we pay the most possible premium? I don't care what the death benefit is, keep it as low as possible. And I'll just use this and take loans from it later and use this as a tax-free retirement vehicle. So if you're putting in all this money for this little bitty amount of insurance, then what you're gonna be able to do not only is put that in and just be done and let that grow forever, but it's just for your insurance, is you can actually also, as this cash value continues to grow, well, what happens is that cash value becomes a part of your death benefit, so you're paying for less and less insurance over time to where eventually you're self-insurable. Yeah, you may have started with a $5 million death benefit, but now that you have $5 million of cash value, that cash value makes up your entire death benefit, where now it's just going to continue to grow tax-free. You can access that tax-free through policy loans, and of course, it will transfer tax-free. And those are the main differences between term, whole life, and universal. Now there's also and this is going to be most important, especially for the type of insurance we're specifically looking at, which is universal, is the 5 parties to every insurance contract. There's the insured, the insurer, the owner of the policy, the payer of the policy, and the beneficiary of the policy. Now, usually the insured, the owner, the payer, these are all the same, but they don't have to be. If you're uninsurable, but maybe you still want to use this, maybe it's on your spouse, maybe it's on your parents, but you don't have to be the insured just to be the owner. Now, the insurer is the company. The insured is the person who, if they die, the money goes to the beneficiary. The owner is the person who has the living benefits, who can take the policy loans, who can access the cash value while they're living. The beneficiary is the person who has the death benefit paid out to them, and the payer is the one who pays the premiums. Now, aside from just being uninsurable, you might be wondering, what case would all 5 of these ever actually be different? Now, the likelihood of this happening is very rare, I understand, but just for an example. The insurer, let's say it's a company, let's say it's nationwide. The insured, the person who we're actually insuring, let's say it's your wife's dad. So if he were to pass away, your wife would suffer a financial loss. That would be unfortunate to her because he was helping her pay for some bills. Because she would suffer a financial loss, we would put your wife as the beneficiary. Now we still need the owner and the payer. So in this case, you happen to be wanting to receive some money from your parents because they just want to give you some money to help out with some of the financial struggles you're going through. And they want to make sure that your wife's dad did pass away, that you and your wife can be okay. So your mom is going to, instead of just giving you money, pay the premiums of the insurance policy and you would be the owner. Again, very complex example, but that is an example of how there is 5 different parties or 5 different roles. Now, a lot of the times the same person is 3 of them, but they don't have to be. And that's it for this one. Very simple start, just going into the differences of those types of insurance, the 5 parties to an insurance contract. Now we are going to get into how can universal life be actually used for the living benefits in episode 2. We will see you there.